What a week it was for precious metals. Gold hit another all-time nominal high, and silver surged toward levels we haven't seen in over a decade. Last week alone, we witnessed the metals continuing their relentless climb, driven largely through macroeconomic uncertainty, persistent physical and geopolitical pressures, and expectations of our U.S. interest rate cuts. Gold managed to settle on Friday at around 38.85 spot, up 29.50 on the day alone, after hitting a record high of 38.96 on Thursday. But as we film today, the momentum has continued. The momentum has continued, pushing gold to $3,909 an ounce. For gold, its relentless rise is sending a clear signal that inflation is far from under control. But the real star of the show, well, that's silver. Silver closed Friday at 47.915, marking a 14-plus nominal year high. Today, silver is trading higher at 48.23 as I film on Sunday night. Its rally was so robust that the gold-silver ratio plummeted to 81.1 on Friday, which serves as one of the key catalysts and something I'm going to talk about today behind the major rally in silver. But here is where it gets really interesting. While silver prices were flying, we saw massive counterintuitive activity in the ETFs. A staggering 16.56 million troy ounces of silver were withdrawn from SLV in just 3 days starting on Wednesday. But despite this giant outflow, silver prices are still up $1.50 an ounce during that period. But here's another really interesting observation. The mining shares, especially silver stocks, continue to lag the metals, which strongly suggests intervention to prevent them from fully reflecting their price rises. All right, so when we talk about silver and we talk about gold, there is so much momentum happening in the market. I'm going to dig in now into some of the technical indicators and help you see what happened and then where I think things are going to go. All right, let's look at a chart on gold. This chart right here is year to date. You can see it's been absolutely phenomenal. And what you can see, though, is the little blue line, you can see that's the 50-day moving average, and the green, thicker line, that's the 200-day moving average. You can see, amazingly, at the beginning of the year, we're down around $2,600 an ounce. And remember, everybody was waiting for that to go below $2,000. Now we're sitting over $3,900 an ounce. But here's what's interesting. If you look on my computer, if I mouse over here, you can see the actual futures contract for gold. This is for the December contract. You can see right now it's at 39.28. So we're clearly in a state of contango, and that's very positive for gold. It means it is likely this week to continue to go higher, as it's indicating right now in the futures market. Let's take a moment now and look at silver. Silver right now, if you look at my chart, is sitting at around $48 an ounce. But what you see also, when I scroll down here just a bit, you can see that the silver futures contract for December is also at $48 an ounce. That backwardation means we're seeing pressure build that's making it harder right now for silver to go higher. That's something to bear in mind and something to be important. Do I think the drivers are still there, though, to push silver higher? I do. In fact, I think the $50 mark, the closer it gets, the harder it's going to be to jam by. But then once we bust through, I think you're going to see silver accelerate to the upside. So am I a buyer of gold right now? Am I a buyer of silver? Absolutely. The charts are indicating that they're both still very strong plays in this market. I was reading some Discord channels this week, and I saw something really interesting on the gold to silver ratio that I wanted to talk to you about. This is an application that exists on the Silver Bullion website out of Singapore. They sell gold and silver to the Singapore market. And what I found really compelling about this is that they've done an analysis of using the gold-silver ratio to trigger when you buy gold and when you buy silver. The rule being that when the ratio gets to 80, you buy silver. When the ratio drops down to 50, you buy gold. So the idea is you're kind of transferring. You're using your silver to buy more gold as we move throughout time. If you look in this case back to 1985, you'll see that you would actually have 4.44 times more gold had you followed the model. But it's not all upside from there and completely clear. I ran the model back from 2020, and what I found was that it basically was even. Pretty much. If you'd have followed the same rules, you'd be sitting at about a 1.0. But over long periods of time, I think you'll find that the gold-silver ratio can be very effective as a trading strategy. The nice thing about it too is it tends to flip every 4 to 5 years. So you're not going in and out. You're giving your metals a time to run, and then you're switching into the other side of the trade. So, as I did in an earlier video, I still strongly believe that all of us should have an allocation to gold and silver. We're often asked which. Well, this model is one way you can use to determine what's the right amount of gold or silver in percentage for you. As it relates to your whole portfolio, we know Morgan Stanley is suggesting around 20%. We know Bank of America is up to 25%. I tend to be a little bit more conservative. I'm down in that 10 to 15% right now, but I'm starting to increase it up. I just think right now is a really great time to be in precious metals, and the analysts are coming around and they agree as well. Okay, I'd like to do a really quick product update because we got something amazing in our office this week. This is the new 2026 Gold Britannia. This is the 1 ounce coin. It is simply incredible. The security features, unparalleled. I'd be curious if any of you know in comments, are there changes to this versus the 25? It's really hard for me to see if there are, but I'm kind of curious. I didn't research it. I also have in my hands the 1/2 ounce. You can see a comparison of it to the 1 ounce. And then if I bring in here is the 1/4 ounce, kind of get a size difference here. Pretty amazing. And then, of course, we also have, and these are always huge sellers, the 1/10 ounce. So this kind of competes in many ways with the maple 1/10 ounce. This is a 24 karat coin, 4 nines gold, amazing, beautifully minted, highly recommended. It's on the website and live today. All right, let's now talk about our forecast the week ahead. Looking ahead, all eyes are on the psychological and technical barrier of $50 silver. Silver is heading directly towards resistance and historic highs at 49.60 and 49.80. UBS analysts have now raised their silver forecast, expecting prices to hit $52 to $55 an ounce, pointing out that silver has greater room to overshoot given its higher market volatility. Many market commentators believe that once silver blows through that $50 mark, as do I, that the market will enter a major phase of mania, meaning people are going to develop FOMO, they're going to become incredibly interested in investing in silver. For gold, the focus is squarely on the $4,000 mark. UPS now expects gold to reach $4,200 an ounce across a near-term time frame. The sustained upward momentum suggests a very high probability of seeing gold trade at $4,000 in this very near future. The fundamental drivers are becoming tectonic, driving this flight from fiat. We are seeing persistent accumulation of central banks, marking the 27th monthly purchase over the last 28 months. This is unparalleled. But the biggest story to watch is the rising chatter around the potential revaluation of U.S. Treasury gold. The U.S. government currently values its 8,133 tons at its legacy price, equating to roughly $11 billion on its balance sheet. If the Treasury were to mark gold, that would bring the figure actually up over $1 trillion. Such a move would allow the Fed and Treasury magically to conjure up almost $1 trillion out of thin air. And the revaluation process itself would certainly drive gold significantly higher than current prices. So keep an eye on key dates. The optimal time to revalue gold would be directly after the December futures contract runs off the board, and the first day of notice of that is November 28th. Overall, the price pressure under all precious metals is now immense, driven by deep pocket institutional interest. You can feel the FOMO. I don't know about you, but I'm getting calls from friends and family. What's up with gold? What's up with silver? People are starting to get on board. But if you watch some of the videos, whether it was from 2 is 1 this last week or Bald Guy Money, you can see we are just at the beginning of this move. So now is the time to engage. Now is the time to get in before the market gets truly frothy. We see a structural long-term trend that suggests we are just at the beginning of this bull market. All right, that's my synopsis for the week. Really looking forward to an exciting week in gold and silver, platinum, and all the other precious metals. What an amazing time for us to be in this market. Thank you so much. Please like and subscribe, and look forward to seeing you next week. Thank you.